People ask successful investors all the time, what's the secret to making money while you sleep? The answer disappoints them because there is no secret. There's only sanity repeated until it becomes wealth. But nobody wants to hear that because sanity is boring and boredom doesn't sell. The modern investor has been infected with a peculiar delusion. They think passive income means downloading an app, clicking a few buttons, and watching money appear. What they're really looking for is magic. And magic has never existed in the history of capitalism, no matter how many YouTube gurus promise otherwise. History keeps repeating the same stupidity dressed in new clothes every decade. In the 1,920 seconds, it was Florida swampland sold to people who never saw the property. In the 1,990 seconds, it was dot-com fairy tales with no revenue, no profits, and no realistic path to either. Today it's side hustles, NFTs, and automated drop-shipping empires that promise wealth without work. Different costumes, same circus, same fools paying admission. The names change, but the underlying psychology remains perfectly constant. Human nature doesn't evolve as fast as technology does. Here's what needs to be brutally clear about this game. If someone is selling you a passive income system, they're making their income from you, not from the system. The real passive income earners are too busy compounding to bother teaching courses about it. That should tell you everything you need to know about the guru economy. What actually works is so simple it'll disappoint most people. Take money that isn't needed immediately. Buy ownership in businesses that produce things people actually want. Then sit there like a stone Buddha while time does the work. That's it. That's the whole game. No complicated strategies, no secret formulas, no insider knowledge required. Just patience and rationality sustained over decades. But the average person can't execute this simple strategy. Not because they're stupid, but because they're human. And humans are wired for action, for novelty, for the illusion of control. Evolution designed us to respond to immediate threats, not to sit still while compound interest works. Sitting still feels like surrender to the human brain. So they tinker, trade, optimize, and slowly destroy the only advantage they ever had, time. They confuse motion with progress and activity with accomplishment. Real passive income has a specific definition that most people misunderstand completely. It's the dividend check that arrives whether you're awake or asleep, sick or healthy, smart that day or stupid. It's the rent payment from a tenant in a building bought 30 years ago. It's the royalty from a patent that outlived its inventor. These income streams have one quality in common that's worth understanding deeply. They don't require daily participation. They don't require emotional energy. They don't require constant decision-making or monitoring. The irony is that building true passive income requires enormous activity up front. Money must be earned through actual work, which is decidedly not passive. Discipline must be developed to spend substantially less than earned, which requires daily choices and constant vigilance. Businesses must be studied until the durable can be separated from the temporary, the real from the fraudulent. And then here's the hardest part that breaks most people. Nothing must be done for decades while everyone around you is doing something. While neighbors are day trading meme stocks, the successful investors sit still. While brothers-in-law are flipping houses and bragging at family dinners, the wealthy investor sits still. While financial media screams about the next big thing every single week, the patient investor holds the same boring businesses bought years ago. This psychological challenge is far harder than any intellectual challenge in investing. When Berkshire Hathaway was being built, the approach wasn't to find 100 clever ways to make money. It was to find one or two ways that actually made sense and could be repeated without heroic effort. Quality over quantity, concentration over diversification, patience over cleverness. This philosophy is what separates wealth builders from wealth destroyers. Take insurance as an example of what works in the real world. Most people think it's boring. They're right. It is boring. But boring industries run by competent, honest people produce rivers of cash year after year. And that cash, when reinvested into more boring businesses at reasonable prices, compounds into something that looks like genius but is really just arithmetic. The magic isn't in complexity or sophistication. The magic is in letting simple arithmetic work uninterrupted for 40 or 50 years. Very few people have the temperament to let this happen. The problem with modern investing advice is that it's specifically designed to keep people busy, Busy people trade more frequently. Traders pay more fees. Fees make advisors rich and clients poor. It's a wealth transfer system masquerading as wealth creation. This is how the game is rigged against ordinary investors who don't understand the incentive structures. Someone once asked a successful investor how often they should check their portfolio. The investor asked them how often they check to see if their house is still standing. The question confused them completely. That's because they thought of stocks as ticker symbols that bounce around, not as ownership stakes in actual businesses. Once you understand you own a piece of a business, the daily price becomes irrelevant noise that distracts from what matters. The business fundamentals, the competitive advantages, the quality of management, these are what determine long-term value. True passive income is what happens when price gets separated from value in your thinking. The price of Coca-Cola stock bounces around like a drunk at a bar. But the value, the actual business of selling sugar water to billions of people around the world, just keeps grinding forward regardless of market sentiment or mood. Own the business, ignore the price fluctuations, collect the dividends, reinvest those dividends, repeat for 50 years. If this can be done, wealth is almost guaranteed. The problem is that almost nobody can actually do it. Most investors think they're too sophisticated for this straightforward approach. They want multi-factor models, algorithmic strategies, exotic derivatives, alternative investments. What they really want is to feel smart, to feel like they're operating at a level above ordinary investors. But the market doesn't pay you for feeling smart. It pays you for being right. And being right usually looks embarrassingly simple. Here's a test that reveals everything about an investment strategy. If it can't be explained to a reasonably intelligent 1-2-year-old in under 2 minutes, it's not a strategy. It's confusion wrapped in jargon to disguise the fact that there's no real edge. The best ideas are always simple enough for a child to grasp. Buy good businesses at reasonable prices and hold them forever. A sixth grader could understand that concept immediately, but adults somehow can't execute it. The reason is emotional, not intellectual. People need activity to feel productive, to feel like they're earning their returns through effort and intelligence. An investor who does nothing for 5 years feels like they're failing, even if their net worth doubled during that period. Meanwhile, the trader who made 100 moves feels accomplished, even though they're poorer after accounting for fees, taxes, and opportunity costs. There's a reason the wealthy made most of their money from a handful of decisions, not from constant activity, not because they didn't have other ideas or opportunities. They had thousands of ideas presented to them, but they developed the discipline to wait for the obvious ones, the situations where the odds were so heavily in their favor that even they couldn't mess it up. They passed on thousands of opportunities to avoid making stupid mistakes. That's not laziness or lack of ambition. That's wisdom. That's inversion thinking applied to portfolio management. Brilliant people have been watched destroying themselves financially because they couldn't tolerate simplicity. They needed complications to match their self-image as sophisticated thinkers. They built elaborate tax shelters, chased private equity deals, invested in their cousin's cryptocurrency startup because it sounded cutting edge. 20 years later, the regular person who just bought a low-cost index fund and forgot about it had more wealth and dramatically less stress. That's the dirty secret the financial industry doesn't want anyone to know. The truly passive part of passive income isn't about the money or the investments. It's about ego. Passivity is required to let reality work without constant interference, without the need to feel involved or important. Most people can't do it. Their ego demands participation. They need to check prices, read analysis, make adjustments, feel like they're actively managing their financial future. Consider a conversation from 1999 that perfectly illustrates this psychological trap. A young investor, very bright with an impressive academic background, asked a veteran investor why he wasn't buying internet stocks. "The world is changing forever." The young man said with genuine conviction, "Don't you want to be part of the future?" The veteran said he absolutely wanted to be part of it as a customer and user. He was happy to use Google, Amazon, and these new technologies. But he didn't understand how most of these companies would make sustainable profits, so he didn't invest. That's called staying within your circle of competence. The young investor laughed at him, called the veteran old-fashioned, out of touch, stuck in the past. 2 years later, that bright young investor was completely broke. The veteran was still holding the same boring stocks owned for decades, still collecting dividends, still compounding wealth at a steady rate. The world did change dramatically. Human nature didn't. That's what people consistently miss about passive income and long-term wealth building. It's not about predicting which technologies will change the world or which trends will dominate the future. It's about owning businesses that will survive whatever changes come. Businesses that sold soap, food, insurance, and electricity in 1950 are still doing it profitably today. Sure, the underlying technology evolved significantly, but the business model remained remarkably constant. If real passive income is the goal, stop chasing innovation and start owning consistency. Stop looking for the next big thing and start owning the boring thing that's worked reliably for 75 years. The innovative companies might make someone rich, probably the founders and the early venture capital firms who got in at the ground floor. But the consistent, boring companies make their shareholders rich slowly, reliably, and without requiring genius, luck, or perfect timing. Here's advice nobody wants to hear because it goes against everything culture teaches about success. The best passive income investments are probably in industries that seem dull to most people. If a business excites you, it's probably exciting everyone else too. And when everyone's excited about something, prices reflect optimism and dreams instead of value and fundamentals. You want the opposite emotional setup. You want pessimism surrounding a genuinely good business. That's where asymmetric returns hide. That's where patient capital gets rewarded handsomely. Warren Buffett used to say he'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. That insight changed everything about how intelligent investors approach the market. Wonderful companies keep compounding, even if you overpay slightly because of quality management, durable competitive advantages, and pricing power. Fair companies just sit there, requiring constant attention and intervention. They never quite deliver the returns you hoped for when you bought them cheap. They consume management time and mental energy without producing proportional results. The average investor spends their entire investing life buying fair companies at wonderful prices, thinking they're being clever and value-oriented. Then they watch those mediocre companies stay mediocre for decades, while the wonderful companies they passed on because they seemed expensive compound into generational fortunes. The math of quality beats the math of cheapness over long periods. Here's the mental shift that changes everything about investing and wealth building. Stop thinking about making money as the goal. Start thinking about owning money-making machines that operate whether you're paying attention or not. This shift in perspective changes behavior completely. A dividend-paying stock isn't a ticker symbol that bounces around on a screen. It's a factory producing cash that flows to you as the owner every quarter. A rental property isn't real estate speculation or a way to flip for profit. It's a tenant paying your bills every single month without requiring your daily involvement. Once investments are seen as machines rather than trading vehicles or speculation, the fidgeting stops. The constant checking stops. The anxiety about daily price movements stops. The best investors own businesses they haven't actively thought about in years, because those businesses simply don't require thinking about. They're well managed by competent people, consistently profitable and structurally durable. The only job left is to not sell them out of boredom or impatience. That's passive income in its purest form. Wealth accumulating in the background while time is spent on more interesting pursuits. The tragedy of modern investing culture is that people have confused activity with progress in a fundamental way. They think if they're not constantly doing something, they're falling behind or missing opportunities. But in investing, doing something is usually what makes you fall behind. The winners are consistently the people who found something good and stayed put for decades. Consider what happened during the 2008 financial crisis, one of the worst economic events in modern history. According to every headline, every expert, every talking head on television, the world was ending. Banks were failing. The entire financial system was supposedly on the verge of complete collapse. And what did the successful long-term investors do during this crisis? They kept holding the exact same businesses they'd held through previous market crashes and recessions. Because good businesses don't stop being good businesses just because scared people are selling them at temporarily depressed prices. The people who panicked and sold during that crisis locked in permanent losses and missed the entire recovery. They sold low out of fear. The people who did nothing, who just held quality businesses and kept collecting dividends and reinvesting them, they ended up significantly wealthier on the other side. Not because they were brilliant or had special insight, not because they predicted the recovery or knew exactly when the market would bottom, simply because they understood that temporary pain is the inevitable price of permanent gain in markets. Passive income isn't about avoiding all risk, which is impossible in a dynamic economy. It's about avoiding unnecessary risk, the kind that comes from your own behavior, rather than from genuine market conditions or business fundamentals. Market volatility isn't risk if you're holding quality businesses bought at reasonable prices. Volatility is just opportunity to buy more shares at better prices. The real risk is owning garbage and hoping someone stupider will pay you more for it later in a game of greater fool theory. That's not investing. That's playing hot potato with your retirement fund and hoping you're not the one left holding it when the music stops. Here's the final word on building passive income that actually works. It's not a product you buy from some guru's expensive course or coaching program. It's a behavior pattern you adopt consciously and maintain religiously for decades. Live substantially below your means, no matter how much income increases. Invest the difference in productive assets that generate cash. Reinvest the returns until eventually the returns replace your active income entirely. Then keep doing nothing while compounding does everything. It won't make anyone rich next year. It probably won't make them rich in 5 years. But in 30 or 40 years, they'll wake up one morning genuinely wondering how they accumulated so much wealth while barely trying. That's the real magic of compounding that Einstein supposedly called the eighth wonder of the world. It works invisibly, quietly, in the background, until suddenly it doesn't. Until suddenly the numbers are so large they're almost unbelievable. The world will always produce new schemes, new gurus, new promises of effortless wealth. Every generation gets its own version of the same scam. Ignore all of it. They're selling tickets to a show that never starts, that can't start because the promises are mathematically impossible. Real passive income is boring, it's patient, it's disciplined, and it's the only reliable path to financial independence that's ever been seen to work consistently across different eras, different markets, different economic conditions, and different regulatory environments. If that disappoints you, good. That disappointment is someone else's competitive advantage. While you're chasing excitement and novelty, the patient investor will be sitting collecting dividends from boring businesses. Time will decide who was right. It always does. And time has never sided with excitement over patience. Now, something needs to be addressed directly that most financial advisors won't tell you because it doesn't benefit them financially, to be honest. The greatest destroyer of wealth isn't market crashes, economic recessions, or even bad investments that lose money. It's fees. Small, seemingly insignificant fees that compound against you year after year, eating away at returns like termites in the foundation of a house. When someone charges 1% annually to manage your money, they're not taking 1% of your gains for the year. They're taking 1% of your entire portfolio value every single year. Whether the market goes up or down, whether you make money or lose money, whether their advice was good or terrible, they get paid. Over 30 years, that seemingly trivial 1% annual fee costs nearly a third of your final wealth. Think about that for a moment. A third of your money gone. Not to market losses that might eventually recover. Not to bad investments you could learn from. Just gone, transferred permanently to someone who statistically probably can't beat a simple index fund. Countless investors have been watched handing over their financial future to people who talk confidently about alpha, beta, Sharpe ratios, and optimal portfolio allocation. Most of it's garbage, dressed up in Greek letters and complicated terminology specifically to justify high fees. The brutal truth that decades of data consistently proves: most active managers underperform simple market indexes after accounting for their fees. Most people would be genuinely better off buying a low-cost index fund, paying 0.1% or less annually, and spending their time doing literally anything else besides worrying about their portfolio. But people can't accept this simple truth because it threatens their self-image. They want to believe they're sophisticated enough to require professional management, that their situation is special or complex enough to justify the fees. They want to feel like they're in the game, making moves, staying active in their financial life. What they're really doing is paying someone else to destroy their compounding potential. The fees compound against you while the market compounds for you. Guess which force is stronger over 40 years of investing? Here's a radical idea that will anger the entire financial services industry. Fire your financial advisor. Take that money being paid in fees every year and invest it yourself in a low-cost index fund that tracks the broad market. Then never look at it again except to reinvest dividends automatically. In 40 years, there will be more wealth than 90% of people who thought they were being smart and sophisticated by staying active and using professional management. The math isn't complicated or controversial. Lower costs plus more time equals dramatically more wealth. The finance industry has convinced people that investing is complicated, that it requires expertise and constant attention. It's not complicated. It's simple to the point of being boring. If people realized how genuinely simple successful investing actually is, the entire advisory industry would collapse overnight. So they keep selling complexity, keep inventing new products with impressive names, keep charging fees for services nobody actually needs to build wealth. It's a business model built on information asymmetry and fear. Another uncomfortable truth needs to be stated clearly. Most people who claim to be living on passive income are lying to you, to themselves, or both. Or more accurately, they're living on active income disguised cleverly as passive income to sell a lifestyle. The real estate investor who says he earns while he sleeps is the same person answering tenant calls at midnight when the toilet breaks. The dividend investor who claims total freedom is checking his portfolio 6 times daily, anxious about every market dip and headline. That's not passive. That's obsessive. Real passive income is genuinely rare because real psychological passivity is rare in achievement-oriented people. It requires setting up a system carefully and then genuinely leaving it alone for decades. No checking, no adjusting, no optimizing. Just let it run while you live your life. Most people are psychologically incapable of this level of detachment and trust. They need to feel involved. They need to feel like their intelligence and attention are contributing to results. And that emotional need costs them dearly in returns. The wealthiest long-term investors made most of their money by sitting and doing absolutely nothing year after year. That's not a joke or an exaggeration. That's a deliberate strategy that goes against every instinct. While everyone else was busy buying and selling, repositioning portfolios, hedging risks, and optimizing allocations, the successful ones were reading books and letting time compound their holdings uninterrupted. The less they actively did, the richer they got. This is counterintuitive but mathematically true. But try telling that to someone who's convinced that wealth requires constant action and effort. They'll think it's laziness or lies or both. They cannot psychologically accept that inactivity could be the optimal strategy for wealth building. Here's what nobody tells you honestly about achieving financial independence. The number needed isn't as impossibly high as most people think when they run the calculations. The reason most people never achieve it isn't because they don't earn enough income. It's because they spend too much relative to what they earn. They keep moving the goalpost as their income increases. They earn more, so they spend more. Their lifestyle inflates in perfect lockstep with their income. They stay on the treadmill forever, running faster but never actually getting anywhere closer to freedom. The real secret to passive income and financial independence isn't finding better investments or higher returns. It's controlling your desires, your need for status, your compulsion to keep up with people who don't actually care about you or your well-being. If someone can genuinely live comfortably on $40,000 annually, they only need a portfolio generating $40,000 to be completely free from work forever. But if they need $200,000 to maintain their lifestyle and self-image, they need 5 times the assets. Most people choose the latter path without thinking, and then wonder why financial freedom remains perpetually out of reach, no matter how much they earn. The most successful wealth builders have lived below their means their entire lives, regardless of income increases. Not because they're cheap or miserly, though they often are accused of being both, but because they understood something fundamental about money that most people never grasp despite years of earning. Every dollar not spent was a worker that could be sent out into the world to earn more dollars through investment returns. Every unnecessary purchase was a worker fired before they could compound. Once money is seen this way, as an army of workers rather than something to spend, everything changes. Once you see money as future purchasing power rather than current purchasing power, spending becomes genuinely painful, not because something can't be afforded in the present, but because the future wealth being sacrificed for present consumption becomes crystal clear. Consider the greatest investment that was never made by a successful investor. Someone could have bought a much larger, more impressive house in the late 1990 seconds during the boom. Friends and family thought it was foolish to sit on wealth and live so modestly. The comments and pressure were constant. But that decision, the decision not to spend on the house, compounded into millions of additional dollars over the next 2 decades. The house that wasn't bought would have been an anchor around the neck, requiring maintenance, higher property taxes, more furnishings. The money that wasn't spent became freedom and options. That's the part about passive income nobody wants to acknowledge honestly. It's not just about making money work for you through smart investments. It's equally about not working against yourself through dumb spending decisions. Every impulse purchase, every lifestyle upgrade, every decision to keep up with wealthier neighbors or colleagues, it's all friction against the compounding machine. The average American family could retire wealthy if they simply drove used cars, lived in modest homes, and invested the difference between what they spend and what they could spend. But they won't do this, because they've been sold a powerful lie that happiness comes from consumption, from impressing strangers with status symbols. So they consume and they work and they consume more and they work more in an endless cycle, never free, never passive, always running on the treadmill until they physically can't anymore. Those who lived below their means for decades have been called all kinds of names. Miserly, cheap, out of touch with how normal people live. Fine. While others were buying depreciating status symbols to impress people they don't like. They were buying appreciating assets and freedom. While others were impressing strangers at parties with expensive watches and cars, they were compounding wealth in silence. Now they can do whatever they want, whenever they want, with whomever they want. That's the real luxury that money provides. Not the car driven or the house owned or the clothes worn. The luxury is not having to drive anywhere or do anything or see anyone if it's not desired that day. Here's the uncomfortable truth about building real wealth over time. It's mostly about what isn't done rather than what is done. Don't buy things that aren't genuinely needed. Don't trade when holding is obviously better. Don't interrupt compounding with unnecessary activity. Don't compare yourself to others constantly. Don't chase status symbols that depreciate. Every negative decision, every time something stupid isn't done, is more powerful than a positive decision. Because avoiding stupidity is dramatically easier than achieving brilliance consistently. Most investing success comes from avoiding disasters, not from hitting home runs. The wealthiest investors didn't get rich because they're smarter than everyone else or have some special gift. They got rich because they avoided being idiots for longer than most people can manage to stay rational. That's the real secret hiding in plain sight. They didn't buy .com stocks at ridiculous valuations during the bubble. They didn't lever up their portfolios during boom times. They didn't panic and sell during market crashes when everyone else was scared. They just sat there year or decade, letting their businesses compound, while everyone else was busy being clever and active. That's what passive income really means at its core. It means money is working, while its owner is busy not being stupid with it. It means removing yourself as the biggest risk factor in your own portfolio through discipline. Most people cannot do this consistently. They are their own worst enemy in investing. They sabotage themselves through unnecessary activity, destructive emotion, and crippling impatience. The enemy isn't the market. The enemy is the mirror. Here's the simplest possible test for whether passive income is actually being built. Ask honestly, if nothing was done with investments for the next 5 years, would there be more money or less money at the end? If the answer is less, there's no passive income being built. There's a job disguised as investing that requires constant attention. If the answer is more, assuming quality assets are held, then congratulations. What most people never figure out in their entire lives has been figured out. But the problem is that most people's psychology won't allow them to pass this test.